Complexity methods have been regularly employed in studying the asset market, which I'll also call the stock market or sometimes the financial market. And this adoption is due to several reasons. First, complexity economics does much better at explaining asset market dynamics than anything else on offer. Second, there's an overwhelming quantity of time series data. And third, asset market participants are highly adaptive and motivated, as there's potentially a lot of money to be made by new insights into market dynamics. This segment will be a brief survey of some themes from complexity-based asset market modeling and findings from a couple of relevant papers. Asset market participants make buy and sell decisions based on expectations about the production capability and sales behind assets, also past asset price trends, but also the expectations of other agents. The Keynesian beauty contest describes the stock market as based on a regression dynamic where, as in a beauty pageant, the goal is not to choose the contestant one thought was prettiest, or even what one might think on average others would decide the prettiest, but to decide on, to quote Keynes, a third degree where we devote our intelligences to anticipating what average opinion expects the average opinion to be, and there are some, I believe, who practice the fourth, fifth, and higher degrees. Brian Arthur sums this up by calling financial markets ecosystems of expectations. Stock market prices are not random walks where a price moves a random amount, either increasing or decreasing at each increment in time, though models sometimes use this random walk mechanism to describe exogenous information about the production activity behind assets. Time series analyses of price data shows that there exist patterns that persist over time until agents develop strategies that arbitrate those patterns. Then they disappear. New patterns also emerge. The efficient market hypothesis says that prices should instantly and correctly adjust to new information about expectations, known as arbitrage efficiency. Here are two graphs from Doyne Farmers toward agent-based models for investment, which is in your reading list. The top graph shows a signal that correlates to future movements of the market, which appeared in the 1970s, but falling off through the 1990s. According to theory, traders discovered this pattern and started raising or lowering prices to take advantage of this information, thus changing the underlying dynamics producing the pattern. The bottom graph shows a signal that emerges in the 1980s and is growing, which runs counter to the idea of arbitrage efficiency, at least in the short term, and shows that markets do not always become more efficient. There are many possible causes for emerging patterns, from world affairs to regulation changes to asset innovations. Thus, patterns emerge that persist in time and take time to be resolved, and new patterns can emerge. Financial market modeling often constructs models in terms of the competitive evolution of different strategies. Agents make decisions based on a simple set of objectives according to a specified strategy. Different classes of strategies together create complex dynamics. From the same paper, here's a time series result from a model involving seasonal traders and technical traders. Seasonal traders buy and sell at regular intervals without much thought to relative prices because they are interested in liquidity, meaning they want to trade in the asset for cash. Technical traders are only looking at the market trends and looking to exploit any patterns to make money by buying at a lower price than they sell. In the graph, in the beginning, the liquidity traders drive the dynamics and produce a clear cyclical up and down pattern. This pattern is exploited by the technical traders who grow in number and wealth. The seasonal traders leave the market and there is a brief period of equilibrium. Then technical traders acquire enough capital that their behavior drives the dynamics into chaos with a competing mix of strategies. From the Farmer and Joshi paper on your reading list, here we see market dynamics driven by the interactions between value investors who base buy and sell decisions on perceived exogenous information about the real-world impact on stock prices, and trend followers, who buy when the price is going up and sell when the price is going down, thus amplifying any trend produced by the value investors. We see that the simulated market behavior plot on the right is qualitatively similar to observed market behavior, which is plotted on the left. Another point is that market structure matters. Your reading in the Markets segment included the Godin-Sudner paper about zero intelligence agents in a double auction market, where the market structure mitigated for the agent's non-rational behavior. Here's a similar theme applied to stock markets with similar results, again demonstrating that market structure can go a long way to determining market outcomes. The complexity economics literature for financial markets changes in 2008 when researchers suddenly became very interested in liquidity contagion effects and regulation. We've seen one of these network papers in our segment on elasticity and discipline. Here are some additional papers from that time period, found in your reading list. In summary, complexity modeling in the stock markets have been very successful and appropriately capture complex dynamics arising from heterogeneous actors interacting asynchronously within institutional contexts. You'll notice Doyne Farmer, a prolific pioneer and proponent of complexity economics, features prominently in all this work. Doyne is currently the director of the Complexity Economics program at the University of Oxford.